Welcome to Miles CPA Review. I'm instructor Varun Jain and today we will start with the auditing part of the CPA exam. Now audit is a very powerful tool and as we know with great power comes great responsibility. So all you future CPAs out here, remember that audit will very soon be your identity. You're all set to become powerful and responsible. Now, to understand audit in a nutshell, we'll use the famous questioning technique known as the 5 W's and the 1 H. So we start with what is an audit? An audit is an examination of financial statements. Why is an audit done? It's done to express an objective opinion as to the fairness of financial statements as per GAAP. That's generally accepted accounting principles. Now, audit makes the financial statements credible. When is the audit done? After the management prepares the financial statements. Who does the audit? We, the independent, the expert auditors, we do the audit, and as part of the audit, we express an objective opinion on these financials which are prepared by the management. Guys, note the division of responsibilities out here. Management is responsible for the financials. We as auditors are responsible for our opinion on these financials. We are not directly responsible for the financials. Now, where do we report our audit findings? Where do we express our opinion? That's done on the audit report. Now, an audit report could have various kinds of opinion. Let's say we are happy with the financials. It's a clean opinion. We say they present fairly as per GAAP. In that case, we will give an unqualified opinion. If we smell something fishy, that's when we give a qualified opinion. If we say the financials are shitty, they're all cooked up, we would give an adverse opinion. There could be circumstances where we do not want to express an opinion. That's when we give a disclaimer. We'll talk about all these different kinds of opinion when we get on with the course. So for now, a clean opinion is an unqualified opinion. Something fishy, that's qualified. Shitty, that's adverse. We do not want to express an opinion, that's a disclaimer. So these are various kinds of opinion that we as auditors can give on the financials. Once again, management is responsible for the financials, guys. We are only responsible for the opinion that we give on these financials. Now, the big question, how do we do the audit? That's done by performing audit procedures as per US GAAP. That's the generally accepted auditing standards. Guys, note, the financial statements are prepared as per GAAP. So management uses GAAP, generally accepted accounting principles, to prepare these financials. They prepare these financials, give it to us. That's where we come in. We do our audit procedures as per US GAAP to express our opinion on these financials. Once again, management responsible for the financials. We as auditors responsible for our opinion on these financials. Now, in a moment, we'll talk in detail about gas. Let's get to the book, do a little bit of highlighting, and we'll come back and I'll give you a lovely mnemonic to remember gas.
Let's get to page 2 of our audit intro section. So an audit is highlight examination of financial statements, highlight to give an objective opinion as to the fairness of those financials in conformity with GAAP. Who prepares the financials? Highlight management prepares financials. And the job of the auditor is to highlight express an opinion on those numbers. Let's look at a little chart that we have on the second half of this page. So management prepares financials per GAAP. The CPA auditor, he comes in, does the audit per GAAP, and the result is the audited financial statements, which are still the responsibility of the management, and the audit report, which includes the auditor's opinion on the financials, and the auditor is responsible for that opinion.
Okay, we just said that an audit is done by performing audit procedures as per GAAP. That's generally accepted auditing standards. Now guys, GAAP is the base on which our entire auditing spectrum is based. There are 10 auditing standards, 10 GAAP. And I'll give you a magical mantra which will ensure that you remember these gas for life. So guys, I, as your audit instructor, give you a general tip. For you auditors, you CPAs, for you to go to the field, go to the client site, get there and take a field pick. So once again, it's a general tip from your instructor for you auditors to go to the client site with your auditor's camera and take a field pick. After you're done seeing all that's happening there, come back and report all clean and dirty elements. Guys, you guys are auditors. You would report everything that you see, everything clean, and especially if anything is dirty. So you report all clean and dirty elements. So guys, here we have the 10 gas on the board. So we have 3 general standards, the general tip that you have from your instructor for you to go to the field, take a field pick, 3 field work standards, come back and report all clean and dirty elements. That's 4 reporting standards. So you have 3 general standards, 3 field work standards, and 4 reporting standards. In short, that's your 10 gas. Now, let's talk in more detail about each of these 10 generally accepted auditing standards. We will start with the 3 general standards, the general tip. The T of the tip stands for training and proficiency. So as an auditor, you're supposed to be properly trained and proficient. That's why you guys are all here, right? Because you want to be properly trained, you want to gather in proper accounting education to become CPAs, to become good auditors. So training and proficiency comes from accounting education, practical experience in auditing, and certainly the industry knowledge in which you're going out and doing the audit. So that's your first general standard, the T of your general tip. The I of the tip stands for independence. That's very important. Now, independence is about being neutral. I don't hate the client, I don't like the client. It's about being objective, acting with integrity. Independence of an auditor ensures credibility. People believe in you because you are independent. Now, independence is required both in fact and in appearance. Now, let's think about it. Let's say you own 30,000 shares in a company with 100,000 shares outstanding, and you go out and do an audit. Won't you want the company to do well so that the value of your shares increase, so that your wealth increases? Yes, you would. Would you still be neutral? Certainly not. Your independence is impaired in fact because you own 30% of the company. You would want that company to do well. Think about a case where you own just one out of those 100,000 shares outstanding. Let's say one share of a $10, which is immaterial to you. Would your independence be impaired? Would you want the company to do really well? You don't care. I mean, it's just a small immaterial stake. But then the public is going to say that a shareholder of this company is auditing the company. Your independence now is impaired in appearance. So now the rules say that you should be independent both in fact and in appearance. So if you own 30%, that's your independence being impaired in fact. If you own just one share, immaterial stake, even then your independence is impaired in appearance. We want to be properly safe, guys. We want properly credible audit reports. We want credible auditors. We want to make sure that audit reports carry a lot of credibility. People can believe in that. So we need to have auditors properly independent. Now, we'll talk about independence in depth when we go to the ethics and professional responsibility section. Let's move on with our general standards. Let's get to the P of our general tip, that's professional care. Now, I would call it due professional care. This is to act with due diligence and ensure that there is no negligence. You must exercise due professional care in planning the audit, in performing the audit, and in preparation of the audit report. Now, you must observe the standards of fieldwork and the standards of reporting. It's about having an attitude of professional skepticism. That's a questioning mind and critical assessment. It's like I neither assume that the management is dishonest nor assume unquestioned honesty. Let's say the client tells you that the allowance for accounts receivable in their company is 2% of the ending accounts receivable balance. You don't say, yes, sir, it's 2%. Neither do you say, I don't trust you guys. You say, I need sufficient, appropriate audit evidence to corroborate with this number 2%. So that's about having an attitude of professional skepticism. Now, I'll give you another concept here. As auditors, we are looking at reasonable assurance. Now guys, absolute assurance would take ages. So we give reasonable assurance regarding the financial statements. Let's take an example. Let's say we have a financial statement item which is, let's say, $1 million. Now, auditing every dollar of this $1 million, that would be absolute assurance. Now that would take ages. It would take us a long time to do an audit and give out an audit reports. It would not make sense. It would be too late. So what we do is we determine a level of materiality. So let's say we say $5,000 is the level of materiality. So anything below $5,000 in this $1 million doesn't really matter. So if it's $1, $5, $10, doesn't matter. But if it's more than $5,000, it would matter. So we determine the level of materiality, and this becomes the scope of our audit for which we give a reasonable assurance. Again, absolute assurance would be every dollar. Reasonable assurance is determining a level of materiality and giving a reasonable assurance based on that scope. So that's about acting with due professional care. Guys, very important. So T is training and proficiency, I is independence, P is professional care. Get this to your head. Let's get to the book, highlight a bit, and we'll come back and talk about the fieldwork standards.
On page 4, we're looking at highlight 3 general standards. That's a general tip. First bubble, write T and highlight training and proficiency. Next bubble, write I and highlight independence. And the auditor needs to be independent. Highlight both in fact and appearance. The third bubble, right? P. So that's the P of our general tip. Highlight professional care. So the auditor must exercise due professional care in the performance of the audit and the preparation of the audit report. The auditor must maintain an attitude of highlight professional skepticism throughout the audit. The auditor exercises highlight professional judgment in planning and performing the audit. And the job of the auditor is to provide reasonable assurance, though not absolute assurance. So the auditor provides reasonable assurance that the financials are free of material misstatements, whether due to error or fraud.
Now that we've looked at the general standards, the 3 general standards, the general tip, let's get on to the fieldwork standards, the field pick. The P of the field pick stands for planning and supervision. Now, as auditors, we are required to adequately plan the audit. That's about designing an appropriate audit program, making sure everything that we do in an audit, all the fieldwork standards, everything is properly planned in advance, as well as supervise audit assistance. Think about an audit team. So it's got an auditor in charge, that's the audit partner, a couple of audit managers, a lot of audit assistants. The audit partner who's responsible, who signs on this opinion that he gives on his financials, he cannot say that the assistant did the job and is just fine. He needs to make sure that the assistants are properly supervised. Now, let's move on to the I of the field pick, that's internal control. Now, internal control is the process affected by the entity's management. which makes sure that financial reporting, that's numbers that you have on the financials here, they're true, they're reliable, they're accurate. So it's basically the process that creates these numbers. That's internal control. Now guys, we've already said that management is responsible for these financials. We as auditors are responsible for our opinion on these financials. Similarly, management is responsible for those internal controls. We as auditors are only responsible for our assessment of those internal controls. Now, the way we do it is management has internal controls in place. We step in. We look at those internal controls. We understand that. So we understand the entity, the environment of the entity and its internal controls. So we understand. Now, depending on how good the controls are, we assess the risk of material misstatement on these financials. Now think about it guys. If the controls are very nice, the risk of material misstatement is low. If the controls are bad, they're pathetic, there's a high risk of material misstatement on these financials. So depending on our understanding of internal controls, we assess RMM. Now, this risk of material misstatement, that is misstated numbers, could be due to error, that's unintentional mistakes, or fraud, that's intentional. So we assess that risk whether due to error or fraud. Now, depending on this risk, we determine the net of our audit procedures, that is the nature, extent and timing of audit procedures, all the audit work we are going to do. That audit procedures includes test of controls, so test of controls is basically the test that we do on those controls that create these financials, that create these numbers. So that's test of controls. The second part, the last audit procedure, is substantive testing, when we do a test of the dollars that you have here. So guys, we are doing test of controls and we also do substantive testing. Test of controls is testing the controls that the management has in place. Substantive test is basically the test of the dollar numbers that you have on the financials here. So once again, we understand internal control, which helps us assess the risk of material misstatement of these financial statements, whether due to error or fraud, which again helps us determine the nature, the extent and timing of audit procedures, which include the test of controls and substantive testing. Now let's get on to the C of a field pick, that's corroborative audit evidence. Now guys, this is our main focus. We do all the hard work, all the audit procedures to gather audit evidence. Now we can provide an opinion on the financials only when audit evidence is sufficient and appropriate. So basically you could say we need enough, sufficient, good, that's appropriate. So we need enough good audit evidence to provide an opinion on the financials. Now audit evidence generally is gathered by doing substantive testing. I told you, right? Audit procedures include test of controls and substantive testing. Substantive testing is the test of dollars. The moment we are testing transactions that happen during the year, account balances that you have on the financials here, we test disclosures. When we do all that testing, we gather in corroborative audit evidence. So guys, let's look at it together. So we have internal control phase where we perform test of controls. Depending on the results of test of controls, we perform substantive tests. Let's look at it in detail. Let's get on the board on that side. So let's say the entity has got strong internal controls. We say we can rely on internal controls. What does that mean? That means that we are okay with doing less audit work. We are okay with doing less of substantive testing. Doing less substantive testing, we are also okay with less evidence, because when we do less work, we gather less evidence. So guys, you're looking at it, right? So if internal controls are very good, if management has proper, very strong internal control creating those numbers, the chances of these numbers being materially misstated is pretty low. And we say we really don't need a lot of work on these numbers. We think that these numbers are going to be correct, they're going to be true. So we do less work. Less work means less evidence. That's okay. Now, the standards do not require any particular amount of audit evidence. It does not say if it's $1 million audit, you need to have 10 files of evidence. No, your audit evidence depends on your judgment. So if the internal controls are good, we as auditors, we are happy with less evidence. We don't need to do a lot of work. We need to make sure that the evidence that we have corroborates. So we need to make sure that we have enough evidence to be able to give an opinion on these financials. How about when internal controls are bad? So let's say if our reliance on internal controls is low. So we go to the company and we say they've got pathetic internal controls, no internal controls. We really doubt that the numbers that they have on the financials here, they may be materially misstated. So we could say there's a high risk of material misstatement. Now in that case, we decide we're going to do a lot of audit work. We're going to test every balance, every account that they have. So we're going to do a lot of substantive testing. If we do more substantive testing, naturally, we would have a lot of evidence. Because given shitty, pathetic internal controls, we will not be satisfied. We will not be able to give our opinion till we do a lot of substantive testing, gather a lot of evidence. So guys, I'm sure you're getting the relationship here. So if internal controls are good, how do we know if internal controls are good if we want to rely? Because we perform the test of controls. So test of controls tell us how good the internal controls are. Should we rely on them or shouldn't we rely on them? Depending on the results of the test of controls, we decide how much of substantive testing we want to do. Substantive testing gives us the amount of evidence. So if it's a company, very systematic company, very good internal controls, we're happy with doing less audit work, gathering less evidence. Bad internal controls means more work and more evidence for auditors. So guys, this is all about your field work. Think about it. This is exactly what you do when you get onto your audit field work. So you first start with planning the audit, making sure that your assistants are properly supervised. Then you look at the internal controls that the management has in place. Again, management is responsible for internal controls. We are only looking at them. Depending on the internal controls, we perform the test of controls, which helps us decide whether to rely on those controls or not rely. If we rely on those controls, we think that we are happy with less audit work, less substantive testing, we gather less evidence. But if those controls are not so good, we would do more audit work, we would gather more evidence.
On page 5, we're looking at highlight 3 fieldwork standards, and that's our field pick. On the first bubble, write P and highlight planning and supervision. With the auditor, he develops a written audit plan. Next bubble, write I, highlight internal controls. With the auditor, must obtain a sufficient understanding of the entity and its environment, including its internal control, so as to assess the risk of material misstatement, RMM, of the financials, and to determine, the nature, extent and timing, that's the net of audit procedures. Now, appropriate internal controls provide confidence to the auditor that material misstatements will be prevented or at least detected and corrected on a timely basis. Strong internal controls means that the auditor could do lesser substantive testing and gather less evidence. But if it is weak internal controls, the auditor does more of substantive testing, more effective substantive tests, and gathers more evidence. We're going to look at this once again when we get to the audit risk model, and at that point I'm going to add the audit risk components to this implication. Let's now move on to our next bubble, right? C, and highlight corroborative audit evidence. With the auditor's job is to obtain, highlight sufficient and appropriate corroborative audit evidence, which, right, supports auditor's opinion, not the financials. And on the bottom of this page, let's make a little note, right? Weak internal controls does not mean that the financials are misstated. An entity could have weak internal controls but still come out with the right financials. Right? But the auditor needs to do more substantive testing and gather more evidence to support his opinion on the financials. So as we said, the auditor must obtain sufficient and appropriate audit evidence. And this sufficiency and appropriateness is based on the auditor's judgment. And if internal controls are weak, the auditor wants more quantity and better quality audit evidence.
So guys, we have now looked at the three general standards. The general tip, that was training and proficiency, independence, professional care. Then we went out of the field. We took a field pick. P was planning and supervision. I was internal control. C was corroborative audit evidence. Now it's time for us to give out our audit report. That's where we said our audit findings are, right? So we have 4 reporting standards which guide us how to write that audit report. So now let's look at all clean and dirty elements. So the A of the all, that's the first reporting standards, is whether accounting principles are in accordance with GAAP. So guys, this is a gas audit to make sure that the financials are as per GAAP. So we as auditors, we as CPAs, we are doing a gas audit. The management prepares these financials as per GAAP. So our report must state whether the financial statements are presented in conformity with US GAAP. Guys, this is an explicit statement in our audit report. We clearly stated whether or not these financials are presented in conformity with US GAAP. That's generally accepted accounting principles. Now, the second reporting standards, the C of clean, that stands for consistency. This is basically whether the management has consistently applied GAAP from year to year. Now, consistency is implicit in the audit report. That is, if the management has been consistent, if they've applied the same principles this year as they had applied last year, we say nothing. But if they have applied different principles, if they have changed GAAP, then we would mention it. So if we are silent in our audit report relating to consistency, that means everything's fine. But if we see that something is changed from last year, we would mention it on our audit report. The D, that's dirty, stands for disclosures. This is again implicit. Now, disclosure means that the management has made proper disclosures in the financials. Again, if we say nothing in the financials, it means there are no omitted disclosures. So again, it's implicit. But if there's something missing, we would put it on our audit report. So guys, we report all clean and dirty elements, where A stands for accounting principles in accordance with US GAAP. C is consistency, D is disclosures. Now E, that's the last gas, that's the fourth standard of reporting. This is expression of an opinion. Guys, this is why we are paid all the big bucks for, to express an opinion on the financials. Remember, we had it right here. So we had the audit is done to express an opinion on the financials. Who gives the audit? Who gives the opinion? We the independent, the expert auditors. We give our opinion on these financials, and we said we are responsible for this opinion. So expression of an opinion is the most important thing. That's why we are there. That's why we are hired for. This is the why of our audit. Now, the expression of an opinion, this again is an explicit statement. So I already told you about the various kinds of opinion. So if it's an unqualified opinion, we explicitly state that the financials are presented fairly in accordance with GAAP. If it's qualified, we would say there's something wrong. This is qualified is like an except for. If it's adverse, we would say they're not presented as per GAAP. So that's an explicit statement. Now, in case we cannot express an opinion, we need to give a disclaimer. We need to state reasons why we are unable to give an opinion. Maybe we are not independent. Maybe we couldn't do enough audit work. We couldn't do enough field work. But in all cases, wherever our name is associated with the financials, our report should contain a clear-cut indication of the character of the work and the degree of responsibility that we are assuming. In other words, the scope of our work. So guys, now we have all the 10 gas here on the board. Now, as I told you, most of our audit syllabus is going to be based on these 10 gas. So I'll tell you how it's going to work. So in audit 1, we're going to focus on the general standards. So this is going to be audit 1, where we're going to cover a major portion of the professional responsibilities and ethics that again deals with independence and professional care. So that's audit 1, the general standards. In audit 2, we'll get to the P of our field pick, that's planning and supervision. Then in audit 3, we'll talk about the I of a field pick, internal controls. Again, management responsible for internal controls. We come in, we understand the internal controls, we assess the risk of material misstatements, and depending on our assessment, we perform the test of controls. Then we would move on to audit 4, where we'll talk about corroborative audit evidence, which needs to be sufficient and appropriate. We would perform substantive tests in audit 4. In audit 5, we would learn about audit sampling. So when we're doing test of controls or substantive tests, we might not want to do the entire population. We might just want to pick up a sample out of that population. So that's what we're going to learn in audit 5. Then in audit 6, we're going to talk about these reporting standards. We're going to talk about how we write audit reports where we express our opinion. Again, opinion, unqualified, qualified, adverse, or even a disclaimer. Finally, we would wrap up with audit 7, where we have all the miscellaneous auditing topics. We would talk about attestation engagements. We would talk about accounting and review services. So that's all there in audit 7. But as you realize, most of our audit is based on this gas. And whenever I start any class of audit, I'm going to talk about this general tip from your instructor for you to get to the field, take a field pick, come back and report all clean and dirty elements. Let's hit the book and let's wind up the introduction in auditing. I'll see you again in audit 1.
On page 6, we are looking at highlight 4 reporting standards. And that's the report all clean and dirty elements, A, C, D, and E. The first bubble, write A and highlight accounting principles per GAAP. So the auditor must state in the auditor's report whether the financials are presented in compliance with an applicable financial reporting framework, for example, GAAP. And this one is underlined in an explicit statement on the audit report. On the next bubble, write C and highlight consistency. So the auditor must identify on the report circumstances in which accounting principles have not been consistently observed in the current period vis-a-vis the prior period. Now, consistency is underlined implicit in the audit report, which means that, right, silence equals okay. So if the auditor does not talk about consistency, it means everything's fine. But if management is not consistent in its accounting principles from year to year, that is when the auditor is going to flag it on the audit report. On the third bubble, write D and highlight disclosures. So if the auditor determines that disclosures are not reasonably adequate, the auditor must state so in the auditor's report. And like consistency, disclosures are also underlined implicit in the audit report, which means that, right, silence equals okay. And the last bubble, right, E, and this one's very important, highlight expression of an opinion. So the auditor's job is to express an opinion on the financials. And this, of course, is underlined an explicit statement in the audit report. On page 7, we're looking at gas as codified in the AUC sections of SAS. So let's talk about it. So in the US, highlight AICPA's ASB, that's the Auditing Standards Board. They develop and issue gas in the form of highlight SAS, which is the statements on auditing standards. On the next bullet, put a box around clarified SAS. Now, in an effort to make US gas easier to read, understand, and apply, the ASB a few years back had redrafted all of the auditing sections in SAS for clarity and to converge with the international standards on auditing. After the convergence, the new codification is prefixed by, put a box around, AUC. So AU, think about it as the first two letters of the word audit. The letter C, that stands for clarity, and that's why we call it clarified SAS, or the clarified statements of auditing standards, which are basically based on gas. Turn a few pages till you get to page 11, where we have authoritative literature on the auditing exams. Now, you, right, can access this authoritative literature when solving simulations. And it's mostly used for, right, research sims. And we've started to look at highlight statements on auditing standards, or SAS. Now, as we get into highlight audit 1, we're going to talk about the PCAOB auditing standards, which is applicable for audits of issuers. We look at ET, which is ethics, the AICPA Code of Professional Conduct. BL, or bylaws. PR, that's the AICPA peer review standards. CS, that's standards for consulting services. PFP, personal financial planning services. VS, that's valuation services. CPE, that's continuing professional education. In highlight audit 2, I'm going to introduce you to QC, or statements on quality control standards, SQCS. And then when we get to highlight audit 7, before we wrap up, we're going to cover statements on standards for attest engagements, SSAE, as well as statements on standards for accounting and review services, SSARS. Now, attest engagements, the prefix is AT. For accounting and review services, the prefix is AR. And both these standards have been clarified. So it's become ATC and ARC. But we're going to be spending most of our time in auditing, covering statements on auditing standards, or SAS. So getting back up on the first sub-bullet, I want you to draw an arrow down to the second bullet and put a box around AU-C. Now guys, on the CPA exams, you never need to memorize section numbers or topic numbers because all of these are accessible to you as authoritative literature when you're doing your simulations. And as I said, you're going to mostly use it for research simulations. But let's just quickly have a look at the AUC codification. So you have AUC 200, which says overall objectives of the independent auditor, and highlight conduct of an audit in accordance with GAS. So basically SAS, that's based around the GAS, and we've already looked at the GAS framework, the 10 GAS, the general tip, field pick and report, all clean and dirty elements. Let's say AUC 300, that's planning and audit. So you can write there PIC and circle P because planning, that's the P of a field pick. 315, you got understanding the entity and its environment and assessing RMM or the risk of material misstatement. This is nothing but internal controls. And you can write there PIC, circle I, the I of a field pick. AUC 500, that's audit evidence. So you can write PIC and circle C because audit evidence, that's the C of a field pick, corroborative audit evidence. Now guys, you don't need to remember these numbers. I'm just taking you through them so that you're aware how SAS or the statements of auditing standards, how do they look? How do they actually flow? And basically, they are in line with the 10 GAS framework that I've already introduced you to. On page 12, let's look at AUC 700s, which is audit conclusions and reporting. So let's say AUC 700, that's forming an opinion and reporting on the financial statements. And you can write there, report ACDE. That's the report, all clean and dirty elements.